Reg, what do you have for us?
Okay, my turn. So C Limited, okay, the guys behind Shopee, Garena, C Money, whatever. We've done a long stock geek out with Thomas Chua from City Compounding. C Limited has announced that they're going to raise $6.3 billion through equity and notes offering. In other words, they're going to beef up their war chest, right? So 11 million American depository shares will be sold into the market. And with that, they're going to essentially, with that and their current cash and cash equivalent positions, they are going to be in a $10 billion war chest situations where they're cold hard cash waiting to compete with their competitors. So I do not put them together with Amazon or the likes of Square or the likes of some of these other bigger guys that are really dominant in their space, Alibaba, JD.com. But if you compare them together with eBay to Etsy, they have at least five times more cash than some of these second-tier competitors, right? And during our Geek Out, we've talked about how Garena itself is churning $700 million every year to funnel the whole growth of Shopee and whatever. So check out our Geek Out. I think you're going to get a lot more information. But based on this new release, what do you guys think, man, about C Limited? Are you concerned that, shareholder dilution? What are your thoughts?
Yes, let's hear from you first.
All right. I'm curious what they want or what they're planning to buy, right? Like you do not raise this type of money without having like 3 or 4 targets in mind, right? So I'm assuming they're already in conversations and they're trying to figure out who these people would look like. So yeah, I wouldn't be surprised if something like that pops up in the near future. Personally, like I don't follow C that much. But just from like when I did a quick look there, a PE ratio of 28 is not that high relative to a lot of competitors. So I wouldn't say that they were super overvalued or anything. For it to be considered like a super smart move to just dilute your shareholders this very moment, right? Because ultimately, like, if you're going to dilute these shareholders, the only way it's going to be accretive is if the what you use it for is actually going to grow much faster or help grow much faster than the amount that you lost, right? That's really all I have at this time.
No, fair enough. Yeah, I think on my side, it's definitely, they're raising the sort of money, they're going to expanding something. Are they starting a new brand? Are they pivoting? Are they sort of putting more money into Shopee, into Garena? I'm not entirely sure, but I would want our viewers to watch this space. I think they are going to be spending big and they're going to be spending big quick. So it's keep a close eye on it is what I would say.
Who is the biggest buy now pay later in Southeast Asia?
I don't know.
Is it the play there?
Yeah. No, but they have C Money, right? So it's gonna be interesting if they buy up someone like that, to raise into this process. Whether is it InsurTech or whether is it brokerage marketplaces, or whether it's buy now pay later payment ecosystems, e-wallet systems. They could easily consolidate a lot of these smaller guys in this space because a lot of them will have limited room for growth, right? And let's not forget that C Limited by far is the biggest and most exciting company that came out of the ASEAN region, right? So, and you're right, yes, they do have a history of essentially running M&As, right? So they have. It's essentially a joint venture, right? Yeah, it's a spec. It's a listing together with Garena and Shopee and C Money after that, right? So they do have a history of that, and we will see if this is gonna happen going into the future, right? All in all, I think I specifically brought this up because I want our listeners to recognize that hey, not all dilution is a bad dilution, right? Because like what Michael Burry said, he told Elon Musk that, hey, at your current valuation, I would sell like 2x more shares. I'll sell a lot more shares to raise capital because the valuations are high into the roof. With cash, they could do so much more, right? And share price were being held very steady because of hardcore Tesla fans, right? So same with C Limited, you see that they are going to sell up 6.3 billion and trying to raise cash of 6.3 billion. But yeah, the prices are staying intact, staying strong, right? So 3% down only, even in the pre-market and aftermarket. So overall, you're seeing the kind of growth and you're seeing the kind of confidence with a lot of these big growth companies selling more, raising more cash, and going through and hustling and trying to consolidate the market. So not all raises are bad. You got to really see what's going on. And not all cash back is good. It's like I'm gonna say, like, I'm very irritated with Spotify announcing that they're gonna do a $1 billion share buyback. They are in a situation that they should not do share buyback. They should spend more money in acquiring content, acquiring position.
Yeah,
flex
buy
themselves.
TFC, Spotify. What are you thinking?
Yeah, I think so. We have a billion. Yeah, it's about a billion.
Yeah. I'm okay. Yeah. So let's see, right? So yeah, exactly. They should be buying and not buying shares at today's valuation, and just kind of clean down their war chest to compete in the content space. So they have to be vividly aware that a lot of these Chinese guys are also coming in to buy content. Okay, let's not steer into a whole like Spotify discussion. We can do this another time, but I just want to take the C Limited example to let everybody know that, hey, not all dilution is a bad dilution, right? It depends on what the company is trying to do, and what price are they diluting at, and what is their cash position going forward. Cool.
Sorry, I think I mentioned earlier is like their PE ratio is 28. I was actually looking at the wrong company, so I do take that back.
Yes. I don't think it's 28.
So what is
well,
their PE ratio?
Their PE ratio is technically negative because they haven't actually made
They have
any
no earnings.
That's true.
So, yeah.
And that is a great lesson, right? Not all companies you should use PE ratio. PE ratio is a valuation model based on historical data, based on what has happened already. So if a lot of these companies that are changing very fast, their growth trajectory is crazy, and they are still negative earnings, you cannot use this to evaluate them, right? So I think a safer bet will be the sum of parts DCF, and you can always go and search more about that. And we have done a little bit of discussion on our podcast as well. Going forward, we will do a little bit more of sum of parts and DCF, to help you close up your gap, your knowledge gap in this way of valuation. Cool.